Germany's industrial sector showed a flicker of life in September 2025, offering a glimmer of hope after months of stagnation and uncertainty. Industrial production rose by 1.3% month-on-month, a modest but welcome increase for Europe's largest economy. Yet this growth fell well short of the 3% rise economists had hoped for, highlighting the persistent challenges facing the sector. The gap between forecast and reality quickly dampened any sense of celebration, leaving many industry leaders cautious. The modest uptick must be seen in the context of ongoing economic headwinds. High energy costs, slowing global demand, and fierce international competition continue to weigh heavily on German manufacturers. September's figure doesn't mark the end of these challenges. It's just a small positive blip in what has been a tough and unpredictable year for the sector. Analysts remain cautious, noting that German industry is still struggling to gain momentum and that the road to recovery is far from certain. The hoped-for strong signal of recovery simply didn't materialize, leaving questions about the sector's near-term prospects. Instead, the 1.3% rise could be a statistical anomaly, or perhaps the first tentative step toward a slow, gradual recovery. This uncertainty makes planning difficult for both companies and policymakers, who must navigate a landscape filled with unknowns. Businesses are left questioning whether to invest in new projects or hold back and wait for clearer signs of improvement, while the government must consider if its current strategy is enough or if more support is needed to spur growth. Ultimately, the September figures serve as a reality check. Germany's economy isn't collapsing, but it's far from roaring back to full strength. The number offers slight relief, not a turning point. Some sectors, like automotive and chemicals, show resilience, but others remain weak and vulnerable. The road ahead for German industry will likely be long, marked by small gains and setbacks, as companies adapt to a changing global environment. Initial optimism has given way to a more sober assessment of the challenges ahead, with many bracing for continued volatility. September's story is one of muted hope, not a definitive recovery, as the sector waits for more consistent signs of improvement. The data highlights both the resilience and the fragility of Germany's industrial base, underscoring the complexity of the current situation. For now, the path to sustained recovery remains uncertain, and the coming months will be crucial in determining the sector's true direction. The 1.3% rise in industrial production hides a fragmented reality, one that is far more complex than it appears on the surface. Growth was driven mainly by the automotive and electronics sectors, which found some positive momentum amid challenging conditions. Without their contribution, the overall figure could have been flat or even negative, highlighting their critical role. Meanwhile, the crucial mechanical engineering sector recorded a notable decline, dragging down the broader numbers and raising concerns. This divergence reveals that Germany's industrial recovery is not broad-based, but rather uneven and inconsistent. Some sectors are advancing, while others, vital to long-term health, are being left behind, creating a mixed performance landscape. Mechanical engineering struggles are especially concerning, as it's a key supplier to many industries and a barometer for global investment trends. Weakness here signals hesitancy in global capital spending, impacting German order books and future prospects. The uneven performance dims hopes for a swift, comprehensive revival, casting a shadow over future growth. A healthy economy needs synchronized growth across its pillars, but Germany's are currently out of sync, creating instability. The September data shows an engine sputtering, not firing on all cylinders, indicating deeper issues. This imbalance leaves the overall structure vulnerable to further shocks and stresses. The fundamental issues plaguing German industry remain unresolved, requiring urgent attention and solutions. The modest growth is built on a narrow, unstable foundation, making it precarious and unsustainable in the long run. Germany's automotive industry showed remarkable resilience in September, stabilizing after months of disruptions from persistent supply chain issues and global uncertainty. The sector is also navigating the rapid shift to electric vehicles, which is transforming the industry landscape and driving innovation. Carmakers ramped up production, fueled by strong global demand for premium electric and hybrid models, and by investments in new technologies. This robust performance helped keep overall industrial output in positive territory, even as other sectors struggled. The electronics sector also played a key role, benefiting from accelerating digitalization trends and steady demand for semiconductors and specialized components. German electronics firms, strong in niche markets, are adapting well to global shifts toward green energy, automation, and smart manufacturing solutions. In contrast, mechanical engineering, a cornerstone of the Mittelstand and a traditional strength of German industry, faced a significant downturn. This sector's decline signals weak global investment confidence as companies delay capital spending and hesitate to commit to new projects. Fewer orders and reduced production in mechanical engineering reflect broader economic uncertainty and a lack of momentum in industrial investment. The divergence between sectors creates a complex challenge. Germany can't rely on automotive and electronics alone to drive growth. Weakness in capital goods points to deeper issues in the export-driven model, raising concerns about long-term competitiveness. A sustainable recovery needs growth across all major sectors, not just a few outperformers. The current split highlights an unbalanced, fragile structure that could leave the economy vulnerable to future shocks. It's a warning sign for the future, urging policymakers and industry leaders to address these imbalances before they deepen. Energy-intensive sectors like chemicals, glass, and paper continue to struggle amid high energy prices. Their output remained stagnant or declined in September, reflecting the direct impact of costly electricity and gas. The chemical industry, a bellwether for German manufacturing, faces tough choices: absorb costs, pass them on, or cut production. Some firms have scaled back or shut operations, threatening jobs and supply chains. Glass and paper producers, reliant on vast energy, are losing ground to global competitors. Government relief on energy prices has come slowly and may not be enough. The stagnation signals deep, lasting damage to Germany's industrial core. Some companies are considering relocating production abroad. The energy crisis remains a major obstacle to a broad recovery. While September saw a rise in new industrial orders, the data is volatile and can be misleading. A single month's increase doesn't offset the broader trend. Over the third quarter, orders actually fell by 3%. This decline suggests businesses are cautious, holding back on investments and purchases. The shrinking order book points to continued weakness ahead for German industry. Volatility in orders makes planning difficult for companies, as sudden spikes can be followed by sharp drops. The underlying trend is clear: subdued demand is likely to persist. German exporters are feeling the effects of global uncertainty. The brief optimism from September's figures is overshadowed by the longer-term decline. Companies should prepare for a period of weak demand. The order books tell a story of caution, not recovery. The future pipeline of work is not as robust as needed. The German government, led by Chancellor Friedrich Merz, has rolled out measures to support industry. Key initiatives include higher infrastructure spending, business tax cuts, and efforts to reduce bureaucracy. The aim is to boost immediate demand and improve long-term competitiveness. Lowering electricity prices for businesses is a critical part of the package, offering relief to energy-intensive sectors. These steps address urgent problems and lay groundwork for future growth. However, most benefits will take years to materialize. Infrastructure upgrades and digitalization are long-term projects. The measures are necessary, but won't deliver a quick rebound. The government is playing a long game, while industry needs faster relief. The gap between policy ambition and immediate results remains wide. Economic experts agree. September's modest rise isn't the start of a turnaround. ING's Karsten Brzeski calls the rebound a temporary fluctuation, not a sustained recovery. Deep-seated structural problems, demographics, slow digitalization, and export dependence continue to weigh on growth. These aren't cyclical issues. They require long-term reform. The government's stimulus measures are necessary, but not a cure-all. Their impact will be felt over years, not months. In the meantime, high energy costs and weak global demand persist. The era of easy export-led growth is over. Recovery will require adaptation, innovation, and patience. There's no quick fix, only a long, difficult path ahead. The German Economy Ministry has offered a candid, cautious view of the latest industrial data. Officials admit there's no sign of a fundamental upswing, despite the small monthly gain. The ministry's focus is on the weak trend, not fleeting good news. This realism helps manage expectations and fosters stability for decision-makers. The government is committed to long-term reform, not short-term optimism. The statement confirms the challenges: high energy costs, weak demand, and the need for transformation. It's a promise to seek lasting solutions, not quick fixes. In conclusion, Germany's September industrial figures show an economy treading water, not surging forward. The 1.3% rise was driven by a few sectors, while others lagged behind. The fractured recovery highlights that the foundations for a broad upswing aren't in place. Forward-looking indicators and expert assessments point to continued weakness. The government's long-term strategy, spending, tax cuts, deregulation, will take time to bear fruit. For now, industry faces a slow, difficult adjustment. There's no single solution. Recovery depends on persistence and innovation. The September data is a reminder of both resilience and deep challenges. Germany's industrial future will be shaped by patient, determined reform. The path ahead is gradual, not a sudden surge.